Move on now and talk about a company which is, debuting on the street very soon. We have Yatra Online's IPO, which has opened today, and it is the third largest online travel company in India in terms of the FY23 gross booking revenue as well as the operating revenue. Now, Yatra is also India's largest corporate travel services provider in terms of the number of corporate clients. Just a little bit about the issue as well. The price band for the IPO is 135 to 142 rupees a piece, and the offer is open up until the 20th of September. So to discuss more on this, let me invite the management. We are joined by Dhruv Shringi, who is the Chief Executive Officer of Yatra Online, and he joins us now to take some questions on how things could really be headed, what their plans are. So, Dhruv, thanks a lot for joining us on this show today. My first question, I will get to the business in just a bit, but you had postponed your IPO last year as well, right? So now your size is a little bit smaller than what you had earlier spoken about. I think earlier you had mentioned around 750 crores. It is now around 600 crores. So why are you bringing down the size? And also on the pricing front, because last year you sold to promoters at around 236 rupees, and now you're willing to pay a stake at just around 140. So if you could take us through some clarity on both of these points.
Sure. Firstly, thank you for having me on your show, and good morning to all your viewers as well. In terms of the size of the offer, see, what we've seen over the last 12 months is that we've seen a very strong recovery happening on the travel side across all segments, right? Business travel, where we are the market leaders, leisure travel as well. So on the back of that, we think from a capitalization point of view, the current number that we've put out of 602 crores is adequate amount of capitalization for us. And we don't need to raise a larger amount at this point of time. I think that's been one key thing which has changed in terms of, just the visibility that we have on the market, the kind of strong tailwind and recovery that we've seen. That's giving us a lot of confidence that the current amount of capital is sufficient. In terms of your second question on the price band, the earlier issue that you were referencing was a rights issue which was done to the promoter group only. That was done based on fair market calculations, fair market value calculations done by the accounting teams and the tax teams. However, this is a price band which has been put forth based on interaction and discussions with the key market participants. You would have seen our anchor book, more than 60% of our anchor book is subscribed by long mutual funds, and we've got a really strong marquee name list on the anchor book. So the current pricing is a function of market forces, and that's where we stand based on input from the anchor investors.
Mr. Shringi, if I could come in over there, just want to talk about the kind of landscape that you're operating in. And, you are smaller compared to your peers like Make My Trip or Ease My Trip in terms of operating revenue, quite smaller compared to MMT. So I just want to understand, and if we look at the objects of the issue, you're saying you're looking at strategic acquisitions, customer acquisition, etc. So can you elaborate on that? What will the game plan be in terms of nearing the gap to your next immediate rival, which would be Easy Trip? I mean, what can be a business USP in a business where I'm assuming margins are pretty much on the thinner side, and then there would be little scope perhaps to maneuver purely on the pricing front, because it's hotels and airlines at the end of the day?
Sure. So just to give you some background and context to this, we are the largest player in the business travel category. Obviously, business travel got impacted quite significantly during the COVID years. But if you were to look at the pre-COVID years, you would see that, we were a clear number 2 player in the overall industry as well. Now, as business travel has recovered, right, and the recovery of business travel has happened more towards the second half of FY23, you would have seen our growth rates being much stronger than our peers, in fact, far outpacing the growth in the market over the last few quarters. So that's the traction that we are carrying in, and it's just the nature of the business mix. And we are quite confident, given the recovery in the business travel, that the gap between us and other players in the industry will close very quickly. In terms of the M&A opportunities, we've done some M&A in the past that we've successfully integrated. These are opportunities, again, focused on the business travel side. To your question on margins, the one thing I want to highlight is that business travel typically has much higher margins. You look at even from a global phenomena, business travel might account for 35% of the volume, but accounts for up to about 75% of the overall profitability of the airlines and the hotels. So that is the most profitable segment of the industry that we are focused on. So yes, from a volume point of view, it might not be as large, but from a profit margin point of view, as the business recovers, it should see a very significant improvement in terms of margins.
Dhruv, to elaborate on that point, what percentage of your revenues come courtesy corporate or business travel? What's the comparable number for peers? And are you back to the pre-COVID level in terms of the revenue contribution from business travel? And again, for you in particular, what would be the contribution to your EBITDA? Is it similar to 75%, which you said for the industry?
So if you look at, pre-COVID, firstly, as a benchmark, right, about half our business was B2C, about half was B2B in terms of gross bookings. Obviously, last year, the recovery happened first in the consumer segment and then in the business travel segment. So last year would have seen, a mix being skewed in favor of consumer. But now as we are going back on a run rate basis, we are pretty close to where business travel was on a pre-COVID level. So that's the reason why there's been a sharper recovery in our numbers in the more recent quarters as business travel has recovered. To your question of margin, yes, overall from a margin perspective as well, the margin would be skewed more in favor of business travel from an overall company perspective.
In your perspective, corporate revenue that you're earning, are you back to pre-COVID levels? If not, how much lower, just about there? Say if you were earning 100 rupees from the corporate side of the business pre-COVID, how much would that be now?
So on a corporate side, we would be close to about 90% of where it was pre-COVID. Yeah.
Okay, got that. If we can just also talk about the split a little bit. I know air ticketing is a big part, but that has been coming down. In FY21, you were close to around 70. I think now it's closer to around 46, 47%. What is the ideal kind of mix that you think is a good sort of split between the different businesses?
So in an ideal scenario, we will see again air ticketing revenue being roughly about 70% of our overall revenue.
Yeah.
Hotels and packages being about 20 to 22%, and the balance 8 to 10% coming in from other products and services.
Okay. Dhruv, on the overall profitability, FY23 you all clocked in a profit of 7 to 8 crores. But before that, you were making losses. I understand the COVID impact, the lingering impact of COVID also. But going ahead, will the company be profitable on a net basis?
Sure. So on a net basis, our endeavor would be to continue to run this profitably. If you see for the last 4 years now, since FY20, at an operating level, we've been profitable. Obviously, there's depreciation on account of the investment which had been made in terms of building out the technology platform, which was there. But as we've come to a stage where now the technology solution would have been fully depreciated, we would see improvement happening in the margin transfer from EBITDA to PAT. The other thing which will also be there is on the back of a stronger balance sheet, the interest cost will come down substantially. So again, the flow through from EBITDA to PAT will improve quite meaningfully going forward. So to answer your question, yes, we do expect to continue to remain profitable.
Mr. Shringi, on that, two-part question. One, going forward, let's say FY24, FY25, what's the corporate versus consumer mix that you are looking to have in your business? If you could give us a ratio. And specifically on the consumer business, I'll just give you my example. A couple of months back, when I had to book a ticket, I just went on the platform which gave me a discount, and I actually got some 700-800 rupee discount. Some platforms are now waiving off convenience fee. Some are offering these discounts, and that's where consumers will head. My example, I think, speaks for all consumers in general. So in that case, are you expecting heightened competitive intensity and maybe some of this discounting to happen on the consumer side?
Sure, I think that's a very good question. So firstly, in terms of the mix, we expect that the mix for this year, FY24, should be closer to about 55-45 in favor of B2C. But what we've also realized is that, ultimately the employees of the organizations that we are servicing, there are about 7 million people who are employed by the companies that we service. They are the consuming middle class of India, right? These are the employees who have access to the internet, access to digital forms of payment, high education, and a high affinity towards travel. So these are the ones that we are cross-selling leisure travel to. And on the platform, it's very easy for them to just simply toggle between business and personal travel. And this entire concept of Be Leisure or Biz Leisure, whichever acronym you want to use, is what is really driving a lot of profitable growth for us on the B2C side as well. Your other point on B2C competitive landscape is absolutely valid. And I think unless you can solve for customer acquisition, which we think we've done by acquiring customers from a business travel platform for personal travel, it is going to be a challenge for B2C players from a profitability standpoint.
Dhruv, your air ticketing as a percentage of gross bookings is, I think, more than 80%. But as a percentage of operating revenues, it's, I think, 47%. Could you explain that for us?
Yeah, so what happens is, in terms of air ticketing, obviously, the booking value is higher, but the take rates on air ticketing are lower than the take rates that you would see on pieces like hotels and holiday packages. They are the higher margin product. So while, yes, the gross booking contribution is higher, the net revenue contribution is lower.
Also, your air ticketing margins have been coming down. FY21, it was at 11.5%. FY22, it came to 8%. And year gone by, it was at 7.5%. Is this going to be a declining trend?
So, in fact, the margins that you're looking at, if you were to look at the 10 years before that, right, before COVID, so in all the pre-COVID era, air margins would have been around the 7.5% mark only. There was a bit of aberration during the COVID period because, suppliers, both airlines and hotels, and the same margin spike you will see in hotels and now normalization, did not have visibility on the kind of traffic trend or the demand trend. So there were some special incentives offered to customers during that period. But now we are back to a normalized environment, and take rates on air around the 7.5% mark are in line with the 10-year average, broadly before that. Similarly, on hotels and packages at 13% is now broadly in line with where it was pre-COVID. So I think just looking at the COVID years in isolation might not be the right way to look at this. You have to look at, over a 10-year horizon, are margins back to a normalized level or not?
Okay. All right. Good speaking with you, Mr. Shringi. Thank you for joining in. Good luck with the IPO plans, and we hope to keep talking to you as you start your listed market journey as well. Well, speaking of journeys, that was actually Yatra. So we'll take a break on that note. We'll come back on the other side, talk about everything that's buzzing in the commodity space. Manisha is going to join in.